The market is currently closed, and the last reported closing price for SoFi Technologies Inc., ticker symbol SOFI, on Monday, December 1, 2025, was $29.03 per share, marking an intraday movement of down 2.32% from the prior close of $29.72. The stock experienced a challenging session, trading between a high of $29.70 and a low of $28.67 before settling near the lower end of that range, which is a significant psychological marker for a stock that has seen such explosive growth over the past year. While the general expectation for SoFi is that it's a high-growth fintech story, continuing its march towards sustained profitability, the immediate reality of that 2.32% drop, particularly on a day when the broader indices were relatively mixed, is a signal that the easy gains from the initial rally are over, and that conviction is beginning to be tested. The key insight that many investors overlook in the enthusiasm of a rally that saw the stock climb over 100% year-to-date is not the strong revenue growth, which is excellent, hitting record highs in the last quarter, but the nature of the institutional selling volume that occasionally pops up, which is what we need to watch next week. That selling often seems to materialize around short-term peaks, suggesting strategic profit-taking or reallocation rather than a fundamental questioning of the business, but it creates a volatility profile that surprises many long-term holders. The common narrative surrounding SoFi is clear. They are successfully transitioning from a student loan refinancing company to a fully fledged, nationally chartered digital bank offering a comprehensive suite of financial products, the so-called fintech super app. This narrative hinges on the success of its three-pronged business model: lending, financial services, and the technology platform, Galileo. The market celebrates the massive growth in member count, now well over 12 million, and the consistent outperformance of analyst earnings estimates, which has been a powerful engine for the stock's parabolic move off its 52-week lows. However, the contrarian and deeper take is this: the market's current valuation, with a trailing price-to-earnings ratio above 50, prices in not just the success achieved so far, but a near-perfect execution of the future business plan, including further margin expansion, significant cross-selling success, and a favorable interest rate environment. The reality is that the student loan business, while rebounding, is subject to political whims and macroeconomic conditions, and the financial services segment, though growing members rapidly, is still operating at a negative contribution margin. The tension is between the market's expectation of inevitable, sustained, high-margin profitability across all segments and the reality of the ongoing high-cost investment required to acquire members and cross-sell services in a highly competitive banking sector. The stock's recent movement reflects this tension. Strong news brings a surge, but a moderate downdraft like the one seen on Monday quickly trims the gains as investors grapple with that premium valuation. Drilling down into the recent stock movement, the decline was accompanied by a trading volume of around 47 million shares, which is notably below the average daily volume that has characterized some of its more volatile sessions. This suggests that the selling pressure was not a panic-driven event, but a more measured, systematic unwinding. The trading range between $28.67 and $29.70 on the session highlights an interesting technical point. The stock has been consolidating its strong gains from the previous earnings announcement, and this range represents a battleground. Bulls are trying to establish a new support level above $29, while sellers are using every opportunity to fade the rallies and push it back toward the $28 territory. The key indicators from last week showed a slightly mixed option sentiment, with a notable amount of activity in both bullish call spreads and bearish put spreads, indicating a high degree of speculation and disagreement about the immediate direction. It is not just about the overall market sentiment, but the specific institutional positioning which we often see reflected in the weekly options flow. The stock's high beta, which is a measure of its sensitivity to the broader market, means that even small jitters in the Nasdaq or the general financial sector can be amplified in SoFi's price, which is another risk factored into the recent daily swings. The core of the business model is what investors are really betting on for the long term, moving beyond the daily noise. SoFi operates under a national bank charter, which is a crucial differentiator from many other fintechs. This charter allows them to hold deposits and originate loans directly, rather than relying on partner banks, which significantly lowers their cost of capital and improves net interest margin. The three main pillars are lending, which includes personal, student, and home loans; financial services, which encompasses checking, savings, credit cards, and investing; and the technology platform, Galileo, which powers many other fintechs globally by providing core processing and program management services. The story of SoFi's growth is really the story of Galileo, the unheralded engine behind the scenes. Galileo's platform is a powerful, recurring fee-based revenue stream that is much less susceptible to credit cycles than the lending segment. When the market prices SoFi, they are giving a premium to this diversified full-stack approach. The company's recent Q3 2025 earnings report was a highlight, delivering $0.11 diluted EPS against estimates of $0.09, which combined with record-adjusted net revenue of $950 million, validated the narrative of scalable growth. The raised guidance across all major metrics, including a substantially higher forecast for tangible book value growth, was a significant positive that propelled the stock higher in November. This raised guidance suggests management has high confidence in their ability to continue converting user growth into profitable products. But again, the market is pricing in this continued outperformance, leaving little room for error. This brings us to the crucial component of short-selling awareness and actionable insights. SoFi is a heavily debated stock, and it has consistently attracted a significant short interest. The latest available data shows short interest as a percentage of float sitting around 9.80%, representing over 116 million shares sold short. This figure is substantial and slightly above the peer average, but it's the days-to-cover ratio of approximately 2.58 days that warrants attention. Days to cover is the number of trading days it would theoretically take for all short sellers to buy back or cover their positions, and a figure above 2.0 is often considered a sign of significant short pressure that could potentially lead to a short squeeze if a strong positive catalyst emerges. We also see a very low borrow rate, around 0.25%, which is a signal that the supply of shares available to short is ample, making it relatively cheap for institutional firms to hold their short positions. The short thesis, which is frequently discussed on forums and sometimes echoed by cautious analysts, centers on the stock's valuation multiple being too rich for a bank, the long-term viability of high-cost member acquisition, and the potential for loan losses to rise if economic conditions worsen. Retail investors on platforms like Reddit often view this heavy short interest as a sign of manipulation or an opportunity for a coordinated squeeze. The reality is more nuanced. While the short positions are substantial, the current low borrow rate suggests the pressure is not intense enough for an imminent squeeze. For investors, the actionable steps here are to monitor the Nasdaq short interest updates every 2 weeks. A significant rapid drop in the shorted shares or a sudden spike in the borrow rate would be a true signal of a change in institutional short sentiment, perhaps preceding a genuine squeeze attempt. Currently, the off-exchange short volume ratio, which sometimes captures dark pool activity, has been elevated, near 40%, which is a statistic retail traders should track, as it speaks to the hidden mechanics of institutional positioning. The key is to avoid chasing volatility purely based on the idea of a squeeze. Instead, focus on the fundamental signals. Look for the company to demonstrate a continued acceleration of positive contribution margin from the financial services segment, and watch the next earnings call for any changes in the forecast for net interest rate. Do you think the institutional short sellers, given the relatively low borrow rate, are simply hedging a well-priced rally, or do you believe they have genuine reservations about SoFi's long-term profitability that the retail market is currently missing? Comment below with your perspective on the rising short interest, smart money, or just a classic hedge against high-growth valuation. Looking ahead, the future outlook for SoFi is intrinsically linked to the macroeconomic environment. A potential easing of interest rates in the coming year, which is a key discussion point among global economists, would be a major tailwind. Lower rates would improve the unit economics of their lending business, making their refinance loans more attractive and boosting the overall volume of originations. The company has also been expanding its crypto offerings and its focus